Sanjay Dongre is joining us from UTI Asset Company. Good afternoon, Sanjay. I would once again like to talk to you about your view on the crude oil prices and how is it likely to impact the economy positively, which in turn could improve fundamentals at large.
Yeah, so it's very difficult to predict the crude oil prices because though the demand has been growing at about 1 million barrels per day every year, the supply has been the issue, and nobody is able to predict the kind of supply which will increase, or they will have some kind of cartel to reduce the supply, and therefore it's very difficult to predict the crude oil prices. But as your earlier speaker pointed out, lower crude oil prices always helps the Indian economy because large part of our requirement we import from outside, and therefore with the crude oil prices declining in the recent times, all your macroeconomic indicators start looking much better. So you will have rupee retracing part of its depreciation, which has happened in the last 3-4 months. We have current account of deficit, which will be still under control. Fiscal deficit, government will be able to stick to. Even the inflation will be lower crude oil prices will help the inflation to remain benign, and therefore RBI will have extended pause on the interest rates for at least in the near term. So overall macroeconomic environment starts looking better with a declining in the crude oil prices.
What's the kind of improvement that you are looking at as far as the market move is concerned, given the fact that macros, which have been a huge pain point for the markets for a very long time this year, are now gradually looking up?
Yeah, so though the macroeconomic indicators have started improving with a fall in the crude oil prices, but the valuation is the one thing which one needs to look at. So today when the market is Nifty is quoting at 10,500, 600, it is really quoting at about 17 times 1 year forward multiple, and therefore which is slightly higher than the average multiple at which the market has quoted in the last 10 years. And therefore since the from the near term perspective, we have various other events lined up, including state elections as well as the general elections, and therefore I would expect the market to remain a lot more volatile in the next 5 to 6 months time. But suffice to say, if the market starts quoting at average valuations are lower than the average valuations in the next 6 months, one should use that volatility to increase exposure to the equity, because I think going forward one could see earnings growth coming back, and that should bode well for the equity market.
The biggest beneficiaries that you think are likely on back of the recovery that's coming back in the market once again? Sanjay, I just wanted to understand what are the beneficiaries according to you that could rise most or see the strongest recovery given the kind of rebound seen in the market?
Yeah, so as I was saying, if there is a market volatility and market starts trading below the average valuations of last 10 years, then one should be looking at the sectors where the probability of earnings growth in excess of 15% is higher. So I would look at the sectors like financials, cement, capital goods, slash engineering, slash infrastructure. I mean, these are the sectors where I would expect in the next 18 to 24 months the earnings growth CAGR to be in excess of 15%, and those are where the earnings growth is higher. Those are the sectors where I would like to put my bets on.
What's making you also bet on capital goods? What is the kind of growth in order inflow that you're seeing, and what are the triggers for it?
Yeah, so if you look at the quarterly results of the some of the capital goods companies as well as the infrastructure companies, the revenue growth has been healthy for these companies, and also we are witnessing good amount of order inflow for capital goods companies as well as the EPC companies who are operating in the sectors such as the roads or railways, on urban transportation and so on and so forth. There are some green shoots of capex happening in the sectors such as steel, fertilizers, oil and gas, to some extent even in the cement sector. So all this bodes very well for the capital goods sector as well as the infrastructure companies or EPC companies to report strong revenue growth as well as the earnings growth in the next 12 to 24 months.
Sanjay, on that note, we'd like to thank you so much for taking time out and coming on board to share your perspective on the markets, improving macros.